Amnish Aggarwal as well joins in on the show right now to talk about his thoughts on the markets. Amnish, hi, morning. Just looking at the GIFT Nifty this morning, and it seems like we're prepping for the 26K mark. But specifically, Amnish, the kind of comeback that banks have made, led, of course, by some of the underperformers from within the large private banking space. You think this time it's sustainable? Because many a times this year, we've seen those false starts.
Yeah, hi Aisha, good morning. If you look at banks, as we have been saying regularly, that they have been underperformers, and particularly if you look at, say, your the big ones, I think due to some reason or the other, the performance has not been that good. Now, incrementally, two things have changed. First of all, banking has got the maximum weightage in the index, and if there is an index-based buying, either by the, you can say, domestics or FIIs, I think the banks are going to do well. And secondly, if you look at the across the broader spectrum, then banks is perhaps the only sector which are trading at a significant discount to where their earlier highs in terms of price to book used to be. So with no big risk looming there in terms of NPAs, growth rates being reasonable, and so are the valuations. So that's the reason the banking has shown some sort of an uptick during the last week. And I don't see that, I don't rule out some bit of, say, further consolidation as we go along. Whether it will happen this week or in the coming few months, that is something which we'll have to wait and watch.
But, just wanted, Amnish, to get your thoughts in on the kind of sector rotation that, one has seen at play. We've been talking about, of course, private banks making a comeback. But what about your, PSU Pack? That really has seen quite a bit of decline. I mean, if you look at some of the fancied names from defense, railways, they've come off a good 30-odd, 40-odd% from their 52-week highs. Do you sense that there could be a comeback over there at play?
In terms of many of these PSU, including the defense stocks, if you look at their multiples, the multiple re-rating was very sharp. Some of them were trading earlier at, say, 10 times, but the multiples went to something like 40, 50 times. Similarly, you look at some of the PSU banks from something like 0.3, 0.4 price to book. Many of them were trading, say, most of them, I would say, between 0.8 to 1.3, 1.4 kind of a price to book range. So I think post that, particularly if you look at, say, your PSU banks, they have not been performing now, but the defense and some of the other segments where the rally has been so sharp and the stocks have given multi-bagger returns, I think there has been decent amount of correction. So I believe that incrementally, if you look at fundamentals in the long term, fundamentals support the stocks. But in the near term, I don't rule out these stocks being sideways for some time before they make any further up move.
Sense, okay. We've been talking about as to how the valuations have been quoting even after the dip that these stocks have seen, and pretty much across the board, everything from a HAL to a Cochin Shipyard to a BEL, most of the fancied names have come off quite a fair bit from their 52-week tops. The other one, of course, is urban consumption. And, Amnish, given that we're already in the festive season, soon we're going to be stepping into Navratri, then Dussehra, then Diwali. It's going to be, 2-month-long celebration. Just wanted to understand what sort of consumption trends do you think will be at play? I mean, we were just chatting about as to how crazy the demand was for the Coldplay concerts, and there are a series of those actually come up. And, CLSA has come up with a very interesting note on urban consumption as well. And, they think that events, travel, eating out, luxury, premium goods, the urban spends, they think, will continue to be intact and will actually spike up this festive season.
You see, this is in line with what we have been saying from quite some time, that the consumption basket for the Indian consumers, both urban and to some extent rural, is changing. That is why some of these, you can say, segments, whether these are discretionary consumptions, travel, events, and all that, I think they will continue to attract more money than the traditional consumption, which we used to say is something like an FMCG or to auto, because structural growth there is not going to be more than mid-single digit. So I think this is a clear trend which is there, and I think which will only increase as we go along into the future, and one needs to be cognizant of this and adjust the portfolio accordingly, because this is going to be the trend. Today, the proportion of discretionary your spending in the urban consumption is rising. The rural discretionary spends are rising at a faster pace, but as we go along and as the per capita income of India increases, we will see more and more of these trends getting depicted, and they will be sooner or later, they are getting reflected, and they will be reflected in the stock price of the companies which are catering to these specific segments.
Amnish, curious to just get in your thoughts, because we're also stacking up the kind of data that we've seen from these banks, and it's interesting that in the last 1 month, the likes of an HDFC Bank, for instance, or an ICICI Bank, Axis, they have done decently well. The PSU banks, on the flip side, not so much. So, what's your assessment as to how the trade is playing out between the private banks versus the PSUs and this rally that's really we've been seeing within the banking space?
You see, what has happened is that in the last 2 to 3 years, we have seen sharp rally coming in PSU banks, and their valuations have seen considerable increase. Now, private banks, they have been doing well. Your credit growth has been good. The only issue has been little bit of LDR, which has been higher in case of certain specific banks. Now, the way we are positioned today, if you look at, say, last 5 to 7 years, while the valuations of PSU banks are at their peak, the private banks, they are still trading at a significant discount to what their earlier peak was. Now, given the fact that the growth rates are good, and now the margin of safety or the undervaluation which PSU banks earlier had, that is no longer there. So the money is now moving towards private banks, where the valuations today are much more comfortable than what they used to be, say, in the pre-COVID area, or even say just beyond that. So I believe from here on also, on a fundamental basis, the banks is a very good trade. So over the next 12 to 15 months, we will see the banks giving you can say, very steady returns from here, particularly the private banks. Uh, However, I think the extent of return and all will also be a function of what happens in the case of unsecured loans, or how some of the banks, they are able to control their LDR. So if the improvement in their performance continues, then I think the banking trade, I think, which has again now started coming more so on the private sector after a few years, I think it has got more legs to go.
What about metals? Because part of the sectoral churn, Amnish, is also being felt through in the way metals are actually making a comeback. And I can say that about the entire commodity basket, but specifically in metals. Do you think with now Fed easing rates, the metal trade is going to come back?
Yeah, usually the commodities do well when the interest rates come down and there's a hope of increasing demand. But as far as your real, you can say, demand is concerned, I think at the global level, we have to wait and watch how the rate cut, it pans out. But however, if there is some increase in the uptick in demand from China, Indian demand has been, say, reasonably good, then this trade can also, I would say, play out. But having said that, the visibility on sectors like banks and all is far more, and your metals usually, it's very sharp. It happens, say, in the 15 days or a month, and then it cools it off. But given the fact that globally there is a trend of cut in interest rates, and we might see some sort of an increase which is coming in the demand, which obviously will happen over several quarters, then your metals can continue to see some strength on the basis of this.
Okay, that's the view coming in on the entire metals basket.
Where do you think Bajaj Housing Finance eventually will stabilize? What's the fair value according to you for this?
It's a very difficult question you have asked me, because Bajaj has been growing well. It can grow at, say, even 25-30% CAGR without difficulty. But if you look at, say, even FY 26-27 numbers, the stock might be trading anywhere between 5 to 5.5 times price to book. So if you look at the price to book of, say, 5.5, it practically doesn't leave anything on the table for at least near to medium term. So while the growth rate may be good, the advantage Bajaj Housing today has got it after the merger of HDFC with HDFC Bank, we don't have any large housing dedicated company. Now, however, our belief is that from the current levels, I think the stock will have long consolidation unless and until you see very astronomical numbers coming from Bajaj Housing Finance. So to buy anything at 5.5 times, there is always an element of risk. So I expect long consolidation to happen in Bajaj Housing.
But do you think somewhere there could be a compulsion which could be at play in Bajaj Housing Finance, because this becomes like now the go-to stock for institutional investors, because this is the only large player in the mortgage market after HDA and HDFC Limited and HDFC Bank merger?
Yeah, Nikunj, that is exactly what has led to the stock which was offered at around say 70 rupees. It's trading at 160, and that is why it might not crack down in a any major way, at least in the near to medium term. And that is why I said it will undergo long consolidation, because the institutional investors they will continue to buy the stock, but the significant outperformance from the current level, I think that is going to take time.
Amnish, what is the concern with HDFC Bank? Is it fundamental or is it technical? If it is fundamental, what is the concern? If it is technical, which is FI selling, that seems to be getting over.
Yeah, Nikunj, the HDFC Bank actually has undergone the merger with HDFC. So once you have, you can say, undertaken this merger, your balance sheet has been redrawn, and you need much more deposit growth than you historically have been doing, and your LDRs they were running at say 105, 110 kind of a number. So although the incremental LDRs now they are coming under control, the balance sheet as such in terms of NPAs and all that remains absolutely clean. And it is only, I would say, the time correction which was happening. On the technical side, you see, today the weightage of HDFC Bank in Nifty, that is, I would say, much more than what actually is warranted. So practically no mutual fund can hold that much amount of stock in their portfolio. So I think these are, I would say, some of the technical factors which actually required more of the FI inflows, as well as you can say domestic non-mutual fund kind of investors to start pulling up the stock. Now with, I think, sufficient time having passed away, some of the ratios also getting, you can say, better, and the visibility improving, I think it is only a matter of time before the stock also, you can say, starts coming into the limelight. But suffice to say, my sense is that a lot of it will also depend upon the FI inflows and FI buying into the stock, because there will be very limited your buying opportunity will the mutual funds have because of the cap on the holding.
So, Amnish, which is one large cap stock where you would say, look, I'm happy to hold it for 3 years. It may go down 10-15%. That's a market call. That's technicals. But I'm happy to hold it for 3 years, and I expect a CAGR return of at least 12-13% for 3 years now.
Nikunj, in banking or anywhere else?
Anywhere. Give me maybe 2-3 stocks which you think that have potential to give a CAGR return of 14-15%. The downside could be 10-15%. It could be volatility. There could be ups and downs. But in terms of earnings and current price, 12-13% CAGR appreciation, which is about 40-50% return in 3 years, could come.
Okay. So Nikunj, one stock which we have been very positive about is Max Healthcare. It's a growth company. It's undertaking acquisitions. The RPOs are superior. You can say your margins are better than anyone else. And I think this stock has undertaken strong consolidation from the year and a half. And the benefit of all the investments will now start reflecting in. So your Max Healthcare is one. The second, you can look at, say, Siemens, because the stock, in line with the other stocks in the capital goods sector, has corrected by nearly 20% from the peak. I think the order books remain strong. The inflows should be good, and I think post demerger the stock will offer value from the current levels. And I think the third one, if you are looking forward to, maybe you can say look at an HDFC Bank or ICICI Bank. But if the banking trade plays out, I think these both stocks are going to give you reasonable returns.
And what's the outlook when it comes to pharma, Amnish, when it comes to earning momentum and from individual players within pharma?
You see, the pharma has seen very sharp rally. If you look at, say, past 6 months or so, the API prices remain benign for most of these players. The pricing pressure is not there in any of the markets. And so if you look at most of these stocks, whether it is, you can say, Sun, Cipla, Lupin, so all of them have done well, and many of them are near their 52-week highs. In fact, last quarter, I think Lupin did exceptionally well, and it is now, and we are recommending this stock even from the current levels. So as far as your near to medium term is concerned, the visibility on pharma stock looks absolutely great.
All right, Amnish, good to have you on board. Thank you for joining in.
If you like this video, then like, share and subscribe to ET Now.